Hello, this is Professor Hazara, and these are just basically for a master's level course, either accounting or MBA. I'm just going through. This is a series of short videos on how what I call is a short form valuation, which is just basically as we would call it in the old days, back of the envelope valuation, a very quick valuation of a company. But the concepts are there, and we'll use it as a base for doing longer term style valuations. Now, what I'm going to do is that there's going to be 5 videos. And as you can see, I've already done this in a sense. I've already done it. Okay, but what I'm going to do is I'm going to make all the numbers 0, and then I'm going to compute them for you, but I'm also going to show you where to get certain pieces of information. And so there's 3 or 4 steps, and I'll do a video for each step. But this is sort of a pre-video, and what I'm going to do is I'm going to show you how to get what I call 2 market inputs for doing this type of valuation. One market input is the price. And when I say valuations, we're trying to estimate stock price. Now, this is going to be a very rough stock price, very rough valuation, because we don't even pull out the liabilities of this one. But this is just a video on where to get these various inputs. Some of them absolutely are going to be guesses, and I'll build these inputs as I go through, and I'll leave the template up if you would like to use this template. I'm just making everything 0 so I can do it for you. And so you can see where I get everything. Okay, so this first video is going to be on where to get 2 what I call market inputs. One market input is the price, and you really don't need the price, but it's a good reference point because that's what we're trying to estimate. And the other market input is the growth rate. Now, this model that we're going to be doing is a 2-stage model. It's a 2-stage model, and we're going to be assuming, number 1, that the first stage is a super growth period. So this would be during a period in which the company is probably young and growing at a substantially higher rate than the growth rate in the economy. And then what we pretend is that after 5 years, so this is going to be, we're going to do this is going to be a 5-year period. And then what we're going to do after that is we're going to assume that the company matures and grows at about the same rate as the economy. And so we call it the constant growth or terminal period. Now, the reason we call it the terminal period is because we assume here that the company will grow forever at the rate of the economy. And we make the assumption that the company's products are now mature, that it's now paying more dividends. It's just a slower growth company. Okay, and it's happened to some companies, it happened to a lot of companies, but you have to keep consistently, because companies change, you have to keep changing your model. Okay, so in this first video, I'm going to show you how to get 2 what I call market inputs. The first input is the price itself. Just go get the price itself. Okay, and then the second input is where do I get a good estimate, a market estimate of how fast this company is going to grow? And it's going to be a market estimate, but this is a market estimate that you may want to verify with your own calculations and see how reasonable it really is. Okay, so let's go for the price. Let's go for the price. Okay, and let's assume that we're doing this valuation as of June 30th, 2020. So it's going to be June 6/30/20. So we want a price about that date. If it's a weekend, we'll take the price probably on Monday or Friday. I don't really care, to be honest about it, for this purpose. Okay, and that's going to be the first input. And the second input is going to be how do you estimate? How does the market estimate the growth rate for a company that's supposed to grow fast? Okay, let's get the price first. Okay, and I'm going to get both these things. If you had a Bloomberg terminal, you would be just fine. But let's go to Google, and then we're just going to go to Yahoo Finance. And now we want 2 things. Remember, we want the price on June 30th, 2020, because that's the date that we're doing the valuation for. And then we also want what the analysts think the company is going to grow at. Now, there's a little inconsistency because the price is going to be for June, but the estimates are going to be for the latest ones. You usually do this on the date that the latest 10Q comes up, but we'll deal with that. You'll at least see where you get the information from. Okay, so let's put an MSFT in here. Okay, this is for the price. We'll go for the price first of all. And you notice you have a bunch of links here, and we're going to be interested in two. We're going to get the price from historical data, and we're going to get the growth rate from analyst earnings estimates, as we call them. Okay, so historical data. Okay, so you see today that at 4 p.m. On February 8th, February 9th, February 8th, Microsoft closed at $242.47. We're interested in getting the price for Microsoft as of June 30th, 2020. Okay, so let's go ahead and do this. We can actually, you go down here to where it says time period, and you have a start date and end date. And the best thing to do is get a range of dates for about 10 days around June 30th, 2020, because sometimes the date that you're looking for is on a weekend, so you want to be able to look at dates before the weekend and after the weekend. Look at prices and dates around there. So this is June 30th, 2020. I'll start June 25th. That'll be my start date. My closing date, it didn't click, my closing date will be let's say July 5th, 2020. Let's say July 5th, 2020. So the range of period that I put in, to hit done, is June 24th, 2020 to July 5th, 2020. And I'm really interested in the price on June 30th. The reason I don't just put June 30th is because it'd be on a weekend. You just like to see what hit apply, and then you just want to see around that date. Okay, so on June 30th, there was a adjusted closing price on June 30th, 2020 of $202.49. Always use the adjusted price because that's the price that's adjusted for stock splits and stock dividends. Okay, so I'm going to go back to my sheet here. Remember 202.49. And so we'll go back to sheet here, and I'll just put in the price here. The actual price on June 30th was $202.49, which is a good price. Okay, and now the other inputs, most of these are going to be guesses actually. We'll work on those as we go along. Okay, but now we want to know what is a good growth estimate of a good growth rate that the market has for the next 5 years for Microsoft, because our model assumes that the company is going to grow for the next 5 years at some high rate, and then that is in stage 2, that's the super growth period. Then in stage 2, which is the constant growth period, then starting in year 6 and forever, the company is going to grow at a much slower rate. And actually, we're going to just guess at that. Okay, and so let's get this 5-year growth rate here. And the place to get that, you can get that from what we call the analyst earnings estimates. Okay, so what you want to go here for MSFT is go over here to where it says analysis. And now this is a table, very important. This is a table that essentially drives stock prices. These are analyst estimates of earnings per share and growth in earnings per share for Microsoft. Okay, now here's how to read these things. I'll read the first table for you, and then the couple of tables in the middle, and then I'll show you what number to use. First table is very important. This gives you the number of analysts per quarter. You can see the quarter along the top, March, June, then the current year, ending June 2021, and the next year ending 2022. These are the number of analysts that are following Microsoft. Notice that the number of analysts is growing, which means that interest in the company is growing. Okay, now for the current quarter, these analysts make models. These analysts actually model financial statements, and they predict what the earnings per share will be for different quarters and different years. So your average estimate, analyst estimate for earnings per share for the quarter ended March 2021 is $1.77. For the quarter ended June 2021 is $1.78. For the year ended, and we know it's June 30th, for the year ended June 30th, 2021, $7.40. And then for the year ended next year, June 30th, 2022, probably is $8.09. So this gives you a number of analysts, the first row. The second row gives you their average estimate. And then the next two rows give you the high estimate and the low estimate. So of these 27 analysts for the current quarter, the average estimate is $1.77, the low is $1.69, and the high is $1.93. Now they give you the low and the high because the bigger the spread between those two, probably the greater the risk. That's a big variance. You think of a normal curve. And then the year ago earnings per share was $1.40. So you can see that the analyst that's 37 cents growth on a basis of $1.40. That's more than 20% growth. So you can see that Microsoft is expected to grow year over year. And you look at the quarter, this quarter here, that's also good growth. Last year, for the year, quarter ended June 30th, 2020, the actual earnings per share is $1.46. And now analysts on average think it's going to earn $1.78. So on a percentage basis, that's pretty good. So that's very important. The second part is revenue. For revenue estimates, this revenue table is exactly like the logic of the earnings per share table, but it just gives you revenue estimates. And I'm not saying it's not important. It's incredibly important because revenue, the top line, drives everything else. But the logic is the same. Okay, now this third table here gives you the earnings history. And what this earnings history table is it compares, it's the past. You notice that all these dates are the recent past. And it compares what Microsoft actually earned against what the estimate was. So for the quarter ended June 30th, March 30th, 2020, the average analyst thought that Microsoft would earn $1.26. The actual earnings per share was $1.40. That's a 14-cent positive difference, and it's a positive surprise by 11%. So they overshot, they exceeded the expected earnings by 11%. Same thing for the quarter ended June 30th, 2000 and June 29th, 2020. The average estimate was $1.34. The actual is $1.46, so they beat it by 12 cents. So those are positive surprises, but that's looking backwards. And they're important, don't get me wrong, but and those are good. That's a good record there because you don't want to miss analyst estimates. So Microsoft is doing well. Okay, two very important tables here are the earnings per share trend, are the trends in the analyst estimates, and these are very important because these are the two tables that drive the stock price. As analyst estimates go up, the stock price goes up. As their estimates go down, the stock price goes down. So we want to know if the estimates are going up or down. And it looks good for Microsoft. So you've got, these are the estimates for March 21, June 21. The year ended June 30th, 21, and the year ended 2022. Okay, so this is saying that if you're looking at the current quarter, 90 days ago, the average estimate was $1.59. 60 days ago, $1.59. But you notice that 30 days ago was $1.58, so more or less constant. But all of a sudden, 7 days ago, it was $1.78, so that is driving Microsoft up, and the current estimate is $1.77. So overall, the estimate has gone up from 9 days ago, from $1.59 9 days ago, to $1.77 now. For the next quarter, this could be seasonal, by the way. Seems like next quarter everything is kind of steady. Is 9 days ago for the estimates 9 days ago for the quarter ended June 30th, 2021 was $1.71. Now they're $1.78. So those got up, not by much, but have got up. But if you look at the years, especially for the year ended 2021, June 30th, 2021, the estimates are way up. 9 days ago, the analysts thought that Microsoft would earn, on average, $6.77. Now all those analysts, on average, the average has gone up to $7.40. So compared to 3 months ago, the estimate is high. That's what drives stock price, increasing estimates. And we'll take a look at the stock price chart in a second to see. So if you just look at these estimates, and for next year, they're also going up, trending up. So that looks good. And these give you their revisions, and you can see that these two tables go together. The actual estimates are going up, and the revisions are actually going up. So you'll see that in the last 30 days, this table here, in the last 30 days, 27 analysts have up, it says up last 30 days. So there's been upward revisions in analyst estimates over the last 30 days, and that's reflected in this upward trend up here. And for the quarter ended, that's for the quarter ended March 21st. For the quarter ended June 30th, 2021, 24 analysts have revised their estimates upward. None for any of these periods downward, and that's reflected in this upward trend. And the same holds true, especially for these 2 years. Everybody is revising their estimates upward. Okay, so I would expect, looking at this, since all these estimates are going upward, that you're going to see over the last 6 months or year, you're going to see a sort of an increase in the stock price. And let's go down to see where we're going to get our input to our model here. Now, if you go to the last table, it gives you growth estimates, and this just says Microsoft right here. Look at the last number here, 16.7%. There's really, I don't think there's anything I can do. Oh, I can. There, I'm going to highlight this here. But that's for my 5-year super growth period. I'm going to input a number of 16.7% as my 5-year growth estimate based on the analyst estimates. Now, so I'll put that in the model. But just out of curiosity, I just want to go back to Microsoft's table here, to their summary, and I just want to look at the price. Now, let's look at the last 1 year. And yep, Microsoft stock has been going up. So in February, of course, when everything was sinking, it was $1.30, $137. Now it's $242, and that $242 is being driven by the fact that the analysts on Wall Street are revising their estimates upward. Okay, let's end this. I think the estimate that we were looking at, the growth estimate, just to remind you, is 16.7%. So the analysts feel that over the next 5 years, Microsoft will be growing at 16.7%. That's where we will end this video as we get into the next one. 16.7%. Actually, we'll do a couple of guesses too. So that's where I'm getting those two numbers from Yahoo Finance. This is just the historical price. This is the average estimate. And I'm just going to go ahead and guess the cost of capital, but I'll give you a couple of rules. I'm just going to assume that the cost of capital for Microsoft for investing in the stock market is 8%. That's probably a little high because interest rates are low. Well, I mean, the stock markets usually have an 8 to 10% premium. Somebody probably correct me on that. So if interest rates are near zero, then 8% would be a bad guess. And then for constant growth. Now, I'm just going to assume that the economy over the long run, because of all the things we're going through, is going to grow at 1%. So this is about the growth of the economy. You could verify that with economists, that sort of thing. I'm sure there's websites you can get that out. And this constant growth period cost of capital. Now, the cost of capital for the super growth period is 8%. We have two rules for the constant growth rate, the cost of capital during the constant growth period. And the first rule is it has to be lower than the super growth cost of capital. So it has to be less than 8%, but it has to be higher than the 1% growth rate in the constant growth. So let's make it about 3%. Make it about 3%. So it has to be lower than that 8% and higher than that 1%. And 3% would be about fine. You're taking the cost of capital for a very low risk company because we're assuming that the company has matured and it produces a lot of cash and we have products that are accepted. Although for any tech firm, I don't know if that's true nowadays. Anyway, so that's where I stopped this first video, and the rest of these inputs actually come from the financial statements. So in the next 3 videos, I will put up the next 3 steps, which is calculating free cash flow. Then we do the valuation of the super growth period and the valuation of the constant growth period. So we calculate the cash flow that goes in initially, and then we grow it at a very high rate for one period and a slower rate for the next period. Okay, I'll stop right there.